Go through three components tonight. And we'll be done in 50 minutes or 55 minutes or so, unless you have a few questions. We can go a little longer. We're going to dispel some of the traditional investing myths. We're going to tell the true story of investing. How do successful investors do it? What decisions do they make up front? And then we're going to give you an opportunity at the end if you'd like to learn more. So dispelling the myths. A myth is a story that's made up to explain the phenomenon or a phenomenon that's beyond the science of the day. We always talk about Galileo to give a good example. Galileo was the first one who said maybe the Earth is not the center of the universe. Right? We had no proof, but he came up with some prisms and mirrors, and he said, you know what, I don't think this is right. Even though it seems like the sun's moving from the east to the west, I think we may be the ones that are moving, and the sun may be stationary. And he had enough proof to make himself comfortable. It took a long time before the institutions of the day, obviously at that point it was the Catholic Church, right? They had a vested interest in their way of reading the Bible, right? So it took a long time for the data to catch up, and it turns out he's right. But this story that, you know, we're the center and the sun revolves around us was wrong, and it's because we didn't have the information. Well, the same with investing. There are myths with respect to investing. And when I'm asked, Evan, you're an investment manager, or you're a financial planner, or you're a stock broker, or a mutual fund advisor, what is it that you do? And people say, you know how to pick stocks better than I do. And I say, no, I probably don't. Or they'll say, you know how to pick mutual funds better than I do because you have the information on 5-star funds. And I say, no, that's certainly not what we're going to be doing. Or, you know if I should be in the market now or if now's a good time to be out of the market. Surely Glenn Beck knows, right? He wants you in gold. But the market timing aspect, should I be in or should I be out? What's going to happen in the next 6 to 12 months? Well, there are myths with respect to that we're going to have to uncover. And then the costs of investing. And we'll talk about that myth as well. So this is the first section. We're going to dispel some of these myths, and these are the categories. So as you look at your book, that was page 1, I think, or page 2, page 3. So now we're going to move on. Stock selection. Stock selection is choosing stocks based on a belief that they will do well in the future. And the myth is that an investment advisor can consistently and predictably add value by exercising superior skill in individual stock selection. Who do you know that is out there saying, buy that stock or don't buy that stock? Do you guys know of anyone who's on television doing that? Jim Cramer, is he rung a bell? You watch him at all this Mad Money deal? I have a little fun clip on Jim Cramer. If I can bring it up quickly, I'll go to it. And I have to stop this one in time because the gentleman who's interviewing Jim Cramer, he doesn't speak like your mama taught you sometimes. So if I stop this a little bit late, I apologize if there's a swear word.
Unfortunately, we haven't heard a thing from CNBC, although Jim Cramer did write an article for MainStreet.com complaining that we had unfairly used a video clip out of context to make it look like he recommended buying Bear Stearns stock a week before it collapsed.
He's a big stock picker. He loves to buy and sell.
We went back to the tape to listen.
Should I be worried about Bear Stearns in terms of liquidity and get my money out of there? No, no, no. Bear Stearns is fine. Do not take your money out. This is random. If there's one takeaway other than a plus 400 somewhere, Bear Stearns is not in trouble.
Okay, I was wrong. Actually, it's true. He wasn't saying to buy Bear Stearns. He was simply saying that if Bear was your broker or that your money was at Bear, your money would not disappear. He was not addressing the value of holding Bear stock. So, Jim Cramer, I apologize. That was out of context. Technically, you were correct. You weren't suggesting to buy Bear Stearns. That was something that you did 5 days earlier in your buy or sell segment.
I believe in the Bear franchise. You know what? At 69 bucks, I'm not giving up on the team.
Yeah! Of course, well, Cramer wasn't giving up on Bear at 69. 11 days later, the stock market was more comfortable with it at 2.
So you get the point. People believe, they want to believe that their mutual fund manager can do this stock selection, that their broker can do this stock selection game better than they can. And so they have someone for that. And we say that this is a myth. We believe that the ability to pick stocks cannot be done consistently over a long enough period of time for it to be valuable to you. That with superior skill, it can't be done. Now, you can talk to me about Peter Lynch, you can talk to me about a few others who have done it for periods of time, But you need to prepare for and retire for a period more like 60 or 70 years, and not for the 5 to 10 or 15-year runs that some have had. But let's look at some of the information. Survivorship bias. Has anyone heard of that term? It's relatively new. Survivorship bias is when a mutual fund that underperforms is no longer desired, it gets killed and enveloped into another mutual fund or into the family of funds. And I don't think this one's in here yet, but I'll bring you to the next page in a minute. Since 1923, when the first mutual fund was born, there was one fund. In 1924, it caught on. There were 3 new funds, and that made it 4 total. All the way until 2009, there were 26,905 funds that you could have chosen from at the end of 2009. More funds than stocks. More combinations of stocks than stocks themselves, okay, that you could have invested in. In that year, the number of dead funds were 2,300. So 10% almost of all the funds that existed were killed in that year. And so we look at the reason, or the total numbers here. The total number of funds opened then the next year in 2010 were 27,500. The total number born since 23, when the first mutual fund came in, was 46,000, and about 19,000 of them were killed. Some funds are enveloped in others or renamed, and so we can look at maybe half of those funds as funds that were renamed. But when you look at the worst 200 mutual funds and their performance, this is squint print, but the average performance of the worst 200 dead mutual funds is a negative 77% per year. Now, you'd expect there to be winners and losers in the mutual fund game. The problem here is that when a fund is killed, the information goes away. So when you get a prospectus from a mutual fund company that says our funds, or 7 out of 10 of our funds, beat their Lipper averages, or beat their proxy, or beat their index, it doesn't include the ones that they killed in November, because they don't have to promote those as funds they own. So the funds they own, sure, 6 out of 10, if that's what they need it to be, they'll just kill 2, and they've got 6 out of 10 beating their averages. Or they'll envelop it in something else. They don't have to promote the returns of the funds that they just killed. So what we did is we went back and got all of the information. And we put the dead funds into all of the other information to get our research done, because these are funds that you probably will have invested in if you invest over 30 years or so. Anybody remember in a 401k that they've ever had if a fund has been killed, or that a list of funds is being changed from this list to this list? Well, invariably 1 or 2 reasons for that exist. Sometimes they're just choosing different funds based on track record performance. Sometimes it's because some of them are being killed. And that information is gone now from the sales material, but it's still in the back, so we can get at it. This is page 4, and you can take notes on it if you want to, but it's pretty easy to determine what's going on. This is the U.S. equity performance trend. Equity equals stocks, okay? Fixed income equals bonds, so that's how I'm going to talk about it. And you've heard of the S&P 500. It's a good gauge for me to use because the information is readily available over long periods of time. It's simply the 500 largest companies in the United States. Okay? So what I'm comparing the blue line, which is the average of all U.S. mutual funds to, is I'm comparing it to the market. And CRSP is the entire market. Every company that existed from 1973 or 72 all the way till the end of 2010. That would be the CRSP, the Center for Research on Stock Prices. The S&P 500 would just be the 500 largest companies. But the average of all U.S. mutual funds underperformed the market over that period of time. If you invested $100,000 in the beginning, it underperformed it by $1.5 million. If you look at the average of all equity funds. Now it's equity funds, it's not bond funds, okay? So this is all stock market funds, and the average of all stock market funds as compared to the market itself. So stock picking by mutual fund managers is not beating the market on average, and not even coming close. If you look at all mutual funds on an average, now you're looking at bond funds, you're looking at international funds, you're looking at those emerging market funds, you're looking at small companies, you're looking at value companies, companies that are distressed, you're looking at all of those different kinds of funds, including the safer ones. And the average of all mutual funds, when you put that real information back in, it turns $100,000 into $1.2 million. And even the most conservative allocation of funds that we offer, which only has 25% allocation into stocks, would have beat it by 1.8 million. So when you take the dead funds and you put them back into the market, you get the real data, and stock pickers are not beating the market by anywhere near average. You'd expect some of them to win and some of them to lose. A few of them, maybe 30 or 40 of them are winning out of 26,000, but finding them ahead of time. And most of them, by and large, are losing by a great margin, if not just being killed for their lack of performance. Okay, so stock picking doesn't work.